Hey guys, Cam McClellan here. Welcome to today's Wealth WOD. We're going to break today's Wealth WOD down into two parts. So we're going to identify in these WODs how many investment properties you need to retire. But first of all, I want you to understand what your end goal is. So normally when we start out investing, we straight away think of the dollar amount you need. How much money do I need? Investing's not about a dollar amount, or it never has been for me. It's never been about the bling. It's first of all been about lifestyle. So once you do an exercise, if you break a page up into 4 quadrants and write health in one section, family in the next section, lifestyle, and then finance. Once you've gone back, I want to look at finance last. So look at health. Outline in there how many days a week you need to go to the gym, what type of diet you need to maintain a healthy lifestyle. With family, outline what environment you want your kids to grow up in, what area you want to live in, what socio-economic area you want to live in. With lifestyle, and family and lifestyle really come together. With lifestyle, it is how much time you want to spend with your kids or doing the things you love. And really, once you've identified what sort of health level you need, what family time you need, what lifestyle you need, then you can easily identify how much money you need. So you can actually put a dollar figure in there. How much money you need passively to support those other 3 quadrants. Once you've got that, then it comes down to identifying how many properties we need. Now the next section here, I'm going to get Michael Beresford to outline for you very clearly 3 different types of investments. So blue chip, medium density capital city property, and cash flow positive properties. And we do an exercise where I'll get him to do 1 blue chip, say 5 medium density, and a dozen cash flow positive properties, and we'll look at what's going to get you to that end goal fast enough. So first of all, quantify your goals, work out what investment you need, and from there your journey is going to be really simple. Cheers guys.
Hey, thanks Cam. Michael Beresford here guys to take you through the finance quadrant that Cam was talking about. We've got 3 different strategies here that I'm going to compare for you. The first is what we call blue chip. So let's say big house, let's call it Brighton for argument's sake, worth $2 million. Okay. The second type of strategy is going to be the medium density. So house and land in existing middle ring growth areas, and let's say that we've got 5 of these type of properties. Finally, we're going to be looking at the cash flow strategy. People love a bit of cash flow, so let's say that we've got 12 properties, most likely regional ones, that are bringing in positive cash flow for us. Okay. Now, critical to understanding not only your borrowing capacity, but also your goals is understanding what available amount of cash flow you've got to actually be able to service these investments. Because wealth creation takes time, and if we're taking time and money away from lifestyle, health, and family to try and get the finance part, it's not going to be a very enjoyable journey, is it? So, if we're looking at what the actual holding cost requirements here, blue chip property, fewer tax benefits, very poor rental yield. These ones are probably costing you about $500 a week out of your pocket. So these numbers in green here, they're the actual holding costs that we're paying for. Now, if we have a look at these, it's more like $50 a week, but let's say that each one of these properties cost you $60 a week out of your pocket. Okay, so after rent, after tax, this whole portfolio is costing us $300 per week, or $15,000 per annum. Okay. Now, finally, over on the cash flow side of things, these properties, because the rental yields are very good, they don't grow in value, but the rental yields are very good. These properties are probably making you $100 a week positive cash flow. So, at first glance here, this one's looking pretty attractive, okay, because we've actually got money coming into our pocket. But real wealth creation is around how you hold growth-focused assets for very little out of your pocket. But if we do the numbers here, we're looking at $1,200 in total per week across these properties, which means $60,000 per annum is the amount of income that's coming in here. Now, over the years of talking to investors about what they want to achieve and what their financial goals are, the most common goal that we hear is that they want to replace their income to be able to spend time with their family, have the lifestyle that they want, and be in good health. Those other quadrants Cam was talking about. So let's explore what these other 2 give us here. If we're looking at a typical Australian income, then really to replace 90 or 100,000, it's going to be very expensive to come up with $25,000 out of our pocket day one to be able to hold this one property. Okay, if we look at this, obviously these 5 properties here, they're not bought all at the same time like the blue chip one is. Over time, as the properties grow in value and the rent continues to increase, while we're saying that $15,000 is the total holding cost, that's assuming we are buying day one, which we're not going to be able to. So this model, easily affordable on a 100K income, okay? And really, what we're talking about is just using some of our discretionary income to be able to hold these properties. Now, far more importantly, okay, is how do we continue to hold this moving forward once we've got these properties to have the financial security and replace our income without having to go to work. The secret comes in living off equity, okay? And really, if we've got these 5 properties here, let's say worth $500,000 each, then that gives us total assets of $2.5 million, okay? So compared to the blue chip, we've got more asset base and we've got much lower holding cost to hold that asset base, okay? So if we look at $2.5 million worth of asset growing at 8% per annum, then what that's giving us year on year on this asset base is $200,000 in growth. Okay, so in order to be able to hold these properties while freeing up money, what we do is we go back to the bank, we release some of this equity, okay? We don't want to release it all. Let's say that we release 150,000 of it. And we use this, because it's equity and not income, we're not paying tax on it. So really, after interest, it's probably only costing us $6,000 or $7,000 to hold. So let's say that we've got 145,000 left to spend. We use 15 of that to hold the property, and we've got ourselves $130,000 in lifestyle income to be able to replace the money that we're not earning by working, and we're able to spend that time with family, on our lifestyle and on our health to have a much better fulfilled life. That's what Cam was talking about, the 3 different options. A bit of cash flow is okay, but we don't get real wealth creation. Medium density, by far the best, because we have low cost to hold and we can utilize living off equity. Blue chip, yes, they can grow in value, but super expensive to hold, which is prohibitive and takes away from our lifestyle while we're building that portfolio. We'll see you next time.